Hello, everyone. Are you a little perturbed about the pullback? Well, don't panic. This podcast is for you. We're off to the first two trading days of the year, and it's been a little bit of a bumpy road to start. But if you want a New Year's resolution that you can stick to, we have a suggestion: learning not how to panic during pullbacks. It's Wednesday, January 3rd, and welcome to another episode of Investing with IBD. I'm your host, Justin Nielsen, and joining me, as he always does, is Arusha Pierce from O'Neill Global Advisors. He's a portfolio manager over there. How was your New Year's, Rusha?
It was okay, and that was quite an introduction there, Justin. You must have been working pretty hard on that for a while.
Well, the perturbed producer doesn't panic, and so he helps out a lot with that stuff. I'm just the puppet, so we're
Yes.
going with all of the P words that I know. But any New Year's resolutions for you?
Honestly, no, I haven't really.
Okay.
I didn't really think about it. Yeah,
It's not for everybody. You know
yeah.
what? You've got
I've,
a
I've given up
whole.
on that. I've given up on the New Year's resolution.
Don't worry, you've got a whole year to think about it,
That's true.
until next year. So, and also joining us on the podcast this week, it's Chris Gessel. Of course, he is the Chief Content Officer at Investors Business Daily, a good friend of mine and my boss, so that's why I'm going to be nice to him as always. How you doing, Chris?
I'm doing very well. It's good to be here.
Excellent. Yeah, it's been a while. We realized we threw you in, and of course, Chris's usual answer to most things is, "Wait, when did I agree to that?" Especially when you take vacation too. Like what?
Right.
Who approved that vacation? But well, let's get into it a little bit. The market. A lot of folks were saying, "Hey, we're looking awfully extended going into the end of the year." We had things that were even wildly extended in terms of like Bitcoin and some of the semiconductors, a lot of the tech stocks. And of course, when things get that extended, and you've run a lot of scenarios, you use our Praveen, one of our programmers. He's got a nice little AI tool that you use to kind of say historically, how far are we from our moving average lines? Is that normal? So when you come to that expectation that a pullback is possible, how do you deal with it? Knowing that it's probably coming, but things are so good, you don't want it to end. So what do you do there, Chris?
Well, there's really three main strategies. One, you can take some profits and reduce your exposure. You can hedge your whole portfolio, or you can hedge individual stocks and do that with puts. And
Yeah.
I think I used to do a lot more hedging with my portfolio. Doing less of that, I'm more likely to sell the things that, maybe they're not looking like the biggest winners. So I'll just bag the profit. But with stocks that I want to try to hold, then I'll hedge them with puts.
Yeah. Okay. We'll definitely get into a lot of that with the second segment. But first, let's talk about the market right now and
Mhm.
where things stand. So we had another rough day in the indexes. Of course, the Nasdaq has been the one taking it on the chin most of all. So we didn't have any sell signals for quite a while, and distribution was very light. Now we're starting to get a little bit of back-to-back distribution. So um, how does that change your outlook?
Well, this is really expected, and the fact that we, gave up the 21-day moving average today, again, not surprising given how far that we've, gone up. So I think that maybe for the last 2 weeks we were surprised, like, I can't believe this market still is going up, and it just, won't give in. But I think the tax selling for the beginning of the year probably kicked things into gear, at least with the pullback. And it's basically going as we expected. And I think that the question is, is it going to moderate somewhat and let the 50-day catch up to it rather than plunging down to the 50-day? That would not look very good.
Mm-hmm.
Yeah, Chris, let's talk a little bit about that, more about the 21-day
Mhm.
when it does break, because and this, IBD Live definitely helped me out with this too, and talking to Mike Webster for years about how important that 21-day moving average is. now this was the first time it's closed below it in probably a couple of months or so.
Right.
Does that, how do you adjust your strategy there? Do you maybe go and reduce maybe some of the higher beta stocks, because usually our stocks perform pretty well when they're above the 21-day, but when the indexes start getting below the 21-day, a lot of those higher beta stocks might need to base out and consolidate for a while.
Well, for me, it all depends on how much profit cushion I have. And so let's say I'm up 20% and on the stock, and that's after losing the 21-day, and maybe it's, I don't know, 7 or 8% to the 50-day. Well, that's a stock I'll sit with, and especially if I've got conviction about it.
And going back to the conviction stocks, do you have a certain number of conviction stocks? Like, I can only have like 3 high conviction stocks, or is it sometimes maybe your whole portfolio is high conviction stocks and you're going to write them all down, or do you try to prioritize a little bit?
Yeah, I mean, I would love to have all conviction stocks.
But that's when it hurts, though. When they do all pull back.
Quite honestly, not if you hedge, and we can get into that later. But yeah, it just depends on where you got in, and do you have enough profit cushion, and is this a real leader, or has the possibility to be a real leader? And that's where the fundamentals come in. I know that we talk a lot about technicals, but before you make a commitment to a stock, you got to have you need to understand the fundamentals, the story, and where it might be going.
So let's talk a little bit about the way in which the pullback happens. And again, if we just kind of stick with the market index right now with the NASDAQ up, we've got the pink line. For those of you that are watching the video, you can always find that at YouTube or investors.com/podcast. The pink line is that 21-day moving average line. And yesterday on Tuesday, it came right down to it to kind of start the year. Seemed like it was getting support, actually bounced kind of at the end of the day. And then, today it kind of went right through it. Now, you mentioned, if it comes down to the 50-day moving average line, I guess it depends on how it does it, right? Is it like one of those nice gradual things? Because already the first 3 days here down have been a little bit more dramatic than what we've seen lately, a little bit more volatility, but we still have like 3.5% until we get the 50-day. So what does that look like? Those different scenarios to you in terms of a pullback to the 50?
Well, if tomorrow and maybe the next day we, let's say we hang around where this bar today is, that would, then the 50 days coming up to the market rather than the market falling down on the 50-day. So, I mean, if we just, fall again another % or more tomorrow, that would not look so good.
And what about levels? I mean, certainly we were kind of looking at that 14,000 level for a while, and that seemed pretty important. We gapped above there and really didn't look back. We had one test kind of at the end of November where it came back down to 14,000, but then really took off from there. And then 15,000, of course, was a level that a lot of us were looking at, another round number. We got above there, only held above it for a few days, and now we're back below it. So are these kind of the guardrails?
Yeah, I would say so. I mean, it would not look good for the market if we lose 14,000 in a dramatic way. And in the same way, when you come up to a round number like 15,000, and even though you poke above it for a day or two, I mean, you really have to claim it and move above it. And so that is definitely the overhead resistance right now.
What about also the fact that now we've collected what I think it's like 4 distribution days maybe on the rally, but when you're looking at the price and volume, especially the volume action as it's been pulling back over the last 4 days or so, and compare it to the volume as it was been going up, are you taking that into account too?
Yes, generally. I mean, the down volume hasn't been as bad. However, one of the distribution days was last week, in between Christmas and New Year's. So that's usually a fairly quiet week, although there were some big days that week as well. I guess I'm less concerned with the volume profile. I think what was more troublesome was how so many stocks really sold off hard yesterday and today.
Mm-hmm.
Now I need to go and look at the market. I've been in meetings, for the last couple hours. So, but it, especially yesterday, there were, some stocks that really went through the moving average and basically just kept falling.
Mm-hmm. Yeah, 4%, 5%, 7%, or greater losses in a lot of those individual stocks. But before we wrap up this market segment, let's go ahead and just take a look at the S&P 500 and the Russell 2000 for kind of comparison purposes. One of the things that we were, I guess, cheering, is that the breadth certainly improved. The S&P 500, which does have a lot of tech, high tech exposure
Right.
based on the market cap. That's still above its 21-day moving average line. And the Russell 2000, we were kind of cheering the fact that this got above 2000, but again, it didn't stay there for very long. That 2000 level, especially if you go back to a weekly chart, you can kind of
Right.
see how it's really kind of an important level. And we've kind of tested it a few times where you get just above it, but it doesn't stay there. So is that another sign of concern that maybe this rally isn't as strong as we thought?
Well, just the action of the Russell over the last few days just seems, a lot more pronounced to the downside than what we're seeing on the S&P and NASDAQ. And, today, I mean, a gap down and it closes right at the low, that's not good action.
And another thing that I think it's worth mentioning, there was a recent shift in the way that the big picture does its market outlook. So rather than going with the confirmed uptrend under pressure, and market in correction, one of the things that we've done is kind of shift that to a more exposure, a little bit more gradual, or more of a gradient, I guess I should say. Market school is something that we've talked about before on this show, something that Charles Harris and Mike Webster created and spoke at, and I kind of did the back office stuff. And with that, we kind of had 5 different levels as opposed to 3. So can you talk a little bit about why that switch happened?
Well, before we just had confirmed uptrend, correction, and uptrend or rally under pressure. And so it was a little, and especially, with our ETF market strategy, generally it was 100% exposure on a follow through day, 0% when we go to a correction. And if we say, rally under pressure, take it down to 50%. But that's not how we handle our own portfolios. So, you get a follow through and you start making some purchases. And then if the market, continues to be strong, you buy more and add to some of your existing positions. And then when things start, getting extended, you start pulling back. And so what we wanted to do was create a system that really reflected how we handle our own portfolios, how we talk about the market and everything like that. And so that's why instead of having these 3 kind of and/or statements, that we could move through the cycle of the market and start with 0 to 20%. It's usually a correction, but it could be a follow-through day too, when if there's nothing really moving on a follow-through day, or it's not the most impressive follow-through day, there's no reason to get super exposed. And then things start looking better. We go to 20 to 40%, and then 60 to 80%. And as we were up until today, 80 to 100, although I'll give everyone a little tip that we did reduce it to 60 to 80 just because we lost the 21 day, whereas yesterday we held it.
Mm-hmm.
Yeah, honestly, yeah, because I just noticed this recently, and I really like it because I think it captures more kind of the realism of being in the markets, where you really ideally want to incrementally increase and decrease and try to go with the flow of the markets, and ideally not do too many things extreme. And I've done that plenty of times when you let them,
Right.
emotions get the best of you. Because if you have a little bit of a position, so say you had some stock and it was doing really well and it started getting hit over the last couple of days, instead of selling out the whole thing, if you hold a little bit of position and now it bounces, I've found that it's a little bit easier to get back into it when it's the right time, versus sometimes when you get shaken out right at the bottom and it starts moving back up again, you're price anchoring. It's really hard to kind of adjust at that because, oh my God, I just sold it much lower. How can I buy it this high?
Right. Yeah, I think that's it. It's more reflective of reality, and I think just a better way to handle your portfolio. And it just gives more insight. I mean, we'll still talk about uptrends, follow through
Right.
days, corrections, but there's a difference on how we're handling it, and it's not all or nothing.
Yeah, and certainly, like a day like today, you can go, rather than going from 80 to 100% all the way down to 50%, 60 to 80. It can be a little bit more gradual, which is nice. And on the flip side, when you have a follow through day, rather than going 0 to 100, it's like, okay, let's go ahead and test it out, see what happens. Do we get some traction, and then go from there. So definitely something that we've been talking about for a while. Glad we got it implemented, and hopefully this is something that really benefits our subscribers. So we'd love to hear from you on how this is working out for you. We're going to take a quick break, and when we come back, we're going to have Chris talk about handling pullbacks, how to not panic, and the different options you have in terms of handling them and protecting your positions. So stay tuned. We'll be right back.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, and it is our first podcast of the new year. Also joining me, as he always does, is Arusha Paris, O'Neill Global Advisors Portfolio Manager, and Chris Gessel is our special guest. Of course, he is the Chief Content Officer at Investors Business Daily, and right now we're talking about handling pullbacks. Certainly, this is a pullback that was expected. We started off the year a little bit rocky. And again, it's one of those things that's kind of hard to manage sometimes, because even when it's coming and you're like looking for the opportunity to even buy on the pullback, sometimes it doesn't feel that great when your portfolio is getting hit. The last thing you're thinking of doing is, oh yeah, let me put some more money to work. So you mentioned kind of three things that you look at: hedging your entire portfolio, looking at individual stocks, you're raising cash. So let's kind of go through some of these, and maybe we start with the overall portfolio. So what's your kind of philosophy here in terms of ways to protect yourself and manage your portfolio during a pullback?
Well, one of the easiest ways, although it's not always very precise, and that is you can buy an ETF like sorry about
SQQQ.
SQQQ.
You could buy an ETF like SQQQ, which is the inverse of TQQQ, which is triple the NASDAQ. And so if the NASDAQ goes down 1%, this is going to go up 3%. So it's a way to really give yourself some protection. And there are ways to look in your trading platform and see the relationship between your portfolio and that ETF. But a lot of times you just need to buy some and then say, okay, well, it's not really working quite well enough. I'll buy some more. And you'll find that happy spot where the market keeps going down and your portfolio is going sideways. And that's a pretty good feeling when you jump on that early and you're ready for it.
Mm-hmm. And it should be mentioned that a lot of times, and we've used this on Leaderboard, a lot of times, you look at the chart and it's like, well, why would you ever buy something that looks like this? You look at the weekly chart, Arusha showed that, and it's like, remember,
that's what I was thinking.
Yeah, there's contango, and there's a lot of things that get involved with the leverage, inverse ETFs, the way that they use derivatives and expiration dates and all that. But you're looking really short term here. This is not, something that you're going to be holding for a long time. It's really to kind of just take some of that pressure off of you, because if your portfolio is getting hit, the idea is that SQQQ will be going up and it will kind of help offset some of those losses. So you're just not taking as big of a hit. Now, what is the risk of using this kind of method of hedging?
Well, there's two risks. One is you might be wrong and the market just rallies and you've missed the rebound. Mm-hmm. The way the market, was so extended, it was highly unlikely that would be, the case right out of the box. And then the other issue is that you're not hedged enough, and that's what I was talking about before. You just need to find exactly where the the happy medium is for your portfolio. And sometimes you can be hedged too much and you're thinking, oh, this is awesome, I'm making money. And then you turn around and the market rallies and now you've lost it. So that's, it definitely can reduce the drawdown, but you need to work at it and you need to pay attention to it.
So is there a way from your experiences, a way to just slowly scale into it? Like maybe 10% of the portfolio to start off with, or 20% with the SQQs to start off with, and then gauge to try to figure out that happy medium?
I've done it both ways, and I'm more likely these days to just to approach it as a short position. And but there, in 2020, when the market was so wild, and we would have these days where the market seemed extended, and then the next day, it would gap down more than 1% in the morning, and then just keep falling. And so that's when I really got into hedging, and I actually started using futures because, especially if you're not on margin or anything, it's very easy to hedge your whole portfolio, because the leverage on futures, like with the NASDAQ futures NQ, it's $20 for every point that the index moves. So that's, you think a triple, TQQ, this is 20-fold. So, which again is good, but it's amazing how you can really get eaten up by, small moves up or down.
And part of that also depends on your portfolio size. Of course,
right.
If you have a smaller portfolio, you're not going to want to do an NQ. You can do the micro minis. There's different instruments out there, but I think it should also be mentioned that sometimes you have to be careful of the instrument that you choose as your hedge. Certainly, one of the things that might have gotten people into trouble this time around is if in 2023, if they were using SQQQ, for example, as a hedge for their portfolio, well, there were times where your stocks might have been going down, but the market was going up because the Magnificent Seven. So if you didn't have the Magnificent Seven, for instance, and you had other things in your portfolio, you could have had a situation where you were losing on both ends. Your stocks were going down and the market was going up, making your SQQQ position unprofitable. So you weren't getting the hedge that you wanted. You were just losing more money.
That's always a risk. And that's one reason why I kind of have moved more to picking the stocks that I really am focused on and I really want to hold, and then buying puts on those to hedge them.
Okay, so
And,
let's talk about
it's
that a
turned
little
out
bit.
that that's my favorite strategy, because when you're right, it absolutely works wonderfully.
Mhm. So let's take an example of something where, okay, you have a position. So how much do you how many puts do you buy in order to hedge that position properly?
Okay, so let's say, okay, this is a great example. In fact, we talked about this. We wrote a story on the day, the peak day from last week,
And this was Marathon
and
Digital, ticker symbol
Marathon
MARA.
Digital, a Bitcoin related stock. And I mean, just look at it. How much was it over the 50-day?
So it was, let's see, I'll give you all the stats here. So it was 136%, really 137% over the 50-day, and 168% over the 200-day,
Right.
and
So,
37% over the 10-day.
so you can look at a stock chart and look at other times where a stock has pulled back and just say, well, how far was it above the 50-day that time? And what is that? 71% there, and then
Yeah, back
go
in
back
July.
to August a year ago.
Yep,
Yeah, right there. How much was it there near the
80%?
80%? Okay,
Yep.
so 70, 80%, and now you're 130 or whatever it was.
Yeah, 137.
That is getting untenable. And in fact, it started pulling back the very next day. So let's say I had 100 shares of Marathon and I'm loving it. I think Bitcoin is still going to dominate in 2024, but I know this thing is so extended, it's got to pull back. So what I would do is I would go in and buy 2 puts for every 100 shares, and I would buy a put with a 50 delta, which means that tells you how much the put moves in relation to the change in the stock price. So if it's a 50 delta and the stock goes down $1, the put is going to go up 50 cents. So if I want to be completely hedged, I know I need to buy 2 of those puts with a 50 delta. And I
the 50
also,
delta is usually going to be the at the money put.
yeah, it's usually right around at the money.
Mm-hmm.
Now, the other thing is you want to go out. Through a lot of trial and error, I would buy cheap puts because it's like, well, I don't want to spend a lot of money. Well, they didn't work. And then I realized when you're doing this properly and you're applying it to a stock like Mara that is extended, the cost of the put is not the outlay. It's really the spread and the time value. And so I'll go out at least 3 months, because usually these things happen. They'll pull back over, maybe a month or so. And, you want enough time so you're not, the puts don't start getting hit by theta decay.
Mm-hmm.
So time decay. So you want, well more than 45 days on that put. And the great thing, and this is why it's my favorite option strategy, is when the stock starts falling, that means the put is getting deeper in the money, the delta is increasing. And so when this thing, let's say this thing goes down to 15 and you're at the 50-day moving average, you're going to be better off between the stock and your puts than you were right there at the top, right above 30, because the puts are going to gain more money than the stock loses, because the delta keeps rising. Wow. So that's why this is my favorite, and it's worked a number of times for me. And again, it works best when the stock is extended. If it's just the market is extended, yeah, you might it's not as dramatic as in the way it works. And then the other good thing is if you're wrong and the stock starts, continuing to move higher, you're going to lose a little bit of money. But the good thing is the delta will start going down, and so you're going to have missed profits, but they're not going to be as great as they were if when you had first bought the put.
So let's go talk about that scenario a little bit more. So say you started to hedge it when it was getting above 20, right? Now you've done it 3 months out. So when it runs up over 30, you're still holding on to those puts, even though now they probably lost like 80% of its, I'm assuming, or something like that, or maybe 50% of its value.
No, I wouldn't be doing something like that. And that's why I use this when it's very clear that the stock is extremely extended. I usually don't put it on when the stock is still going up. I'll wait for the first down day and when it undercuts, or I'll just or when there's a big break in the market or the character of the stock changes. So call up ELF.
Yep.
So I held ELF back in, let's see, this was in, it was in September, or no, I guess it was in, it might've been in October when I first did this one. And I'm sorry, August. So it gapped up and then the market was getting weak and it started to sell off a few days later. And so I'm like, you know what? I think I'll put on a hedge. And so it was kind of going back and forth, and it did go back up to 137. And then a couple of days later, it really sold off hard down to the 50-day. And I think at that point, I got out of it and just decided, you know what, I'll move on. Another one that I did this on recently was, do you remember the ticker, Justin?
This is where Allie would.
I know, Allie would know it. We'll figure it out. So it's just, I mean, it's harder to.
It wasn't ANF, was it?
No, EXTR maybe.
Oh yeah, it was EXTR.
Extreme Networks. Okay, this is a really good example. So this had triggered, David Ryan's ants indicator. So it was up 20% within 15 days, and the volume doubled, and that's as it was breaking out. So I put it on my watch list, and it pulled back to the 21-day, and I bought it. And it was going good. And I was like, oh, this is perfect. And then, there in August, it had that big break on where it, had just hit 32.73 and sold off. And so when it started falling that day, I didn't wait till the end of the day. It was in the morning. That's when I put it on, and I held it until I think I was on vacation and walking through an airport and said,
that's right.
Oh my gosh, this thing is really sold off. This thing looks broken. I'm just going to close it now. But again, I was better off where I sold it probably around $23 or something, rather than if I had sold it right at the top at 32.
Mm-hmm. So on that point, when it was breaking heavily below the 50-day, you sold out of both. You closed both positions. You closed.
I closed both of it because now it's not a stock that I want to be in.
Right.
So it's like, okay, this is dead to me.
Yeah.
And then I'll just move on.
Mm-hmm. So we've got different ways to hedge. You got the use of futures. You've got the inverse ETFs, to kind of look at your overall portfolio. You've got the options for individual stocks using your put strategy. I guess one more to talk about is raising cash. Where does that fit into your overall protection policy?
Well, those are the stocks that I don't have conviction about. Maybe I'm treating it more as a swing trade, or maybe I thought it might turn into something, but it really hasn't. And so when that starts happening, that's when I'll be quick to sell and move out of a lot of stuff. And sometimes they might be great stocks, but maybe I got in late, and so I don't have a big profit cushion. I don't want to round trip a 10% gain. I'm just going to get out when maybe it's down to 1 or 2%, and just so I can walk away at least with a winning trade and wait for another entry. So and that's one reason why I have kind of moved away from hedging my entire portfolio when this happens, and just focus on get rid of the stuff that I don't have conviction about, and the stocks that I think could really be a big mover. Then I'll buy puts on those.
And it's also worth mentioning that for those shorter term trades, a lot of times you might be selling them into strength because you're not thinking that you're going to be holding on to them for that long. And so selling them into strength, this is something that Mark Minervini talked about a couple episodes ago on the podcast. What happens a lot of times is it reduces your exposure. And then if you can't find anything to replace them with, you naturally have kind of a lower exposure portfolio, and so you don't get hit as hard. One more thing though, when do you start taking the hedges off? Because again, what can happen is you're pulling back. If it's just your run-of-the-mill pullback, eventually you get a bounce. And at what point do you start saying, okay, it's time to take the hedges off. It's time to shift thinking and go back into buying mode?
Well, let's say with Extreme Networks, when it came down and it got support there at the 50-day for about a week or so. And so instead of breaking through the 50-day, if it had taken out that high of the day before it really collapsed exactly, then I would have taken the hedge off and just let this thing roll, and then dealt with it with my normal sell rules.
Very good. Well, that wraps it up for this segment. When we come back, we're going to talk about some of the stocks that are on Chris's radar. Stay tuned. We'll be right back.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
Welcome back to Investing with IBD. It's our New Year's special, the first episode of 2024. I'm Justin Nielsen, your host, along with Arusha Paris, who joins me every week from O'Neill Global Advisors. He's a portfolio manager over there. And our special guest this week is Chris Gessel, the Chief Content Officer at Investors Business Daily, and a good friend of mine and my boss. So it's a pleasure to have him on. And let's talk stocks, Chris. Of course, it's sometimes a little bit tougher when you're in an environment like this where you've had a few days down and you're kind of thinking of what to sell, not what to buy. But this is exactly the time when you should be kind of getting that watch list of things that maybe you missed. And it's the old second chance saloon, right?
Absolutely. This is, corrections are the best time to stay engaged, because that's when the best opportunities arise.
So let's go ahead and start with ServiceNow, and I still do have a position in this myself. Let's talk about this a little bit. So it did get extended. I mean, it was up 17% above its 50-day moving average line. Nothing like what Marathon Digital was. It almost hit the 20% profit level. You can kind of see that green shaded area that it kind of fell short. Now it's coming through the 21-day moving average line. And so what are you looking at here?
Well, I'd be watching the 50-day and the 10-week moving average. Now, this is one that I didn't get. And so I've got a lot of these stocks that, I missed in early November and really didn't give you another chance. And so I'm watching those lines and seeing how they come down to them, and then once they hit them, how they act. So, I mean, the good thing is, compared to a lot of the volume on the way up, the last couple days, I mean, that's pretty modest volume. So that looks good to me.
So on a price action basis, say it comes back down to the 50-day, are you waiting for potentially like an upside reversal or something like that, a little bit of confirmation instead of just buying on the way down?
Right. I do want to see some confirmation. I'm not necessarily looking for a full-on reversal. If I'm looking at a 30 or 15-minute chart and it's coming in and touching the line, and then you see on the intraday chart that there's some real buying coming in there, then maybe I'll start a position and maybe I'll buy more on that reversal where it really shows itself. But I want to, if it's getting support where it should get support, then I'm willing at least to risk some money.
And how much is it usually, like a 3%, 5% position on your kind of initial buy on a pullback?
Probably in this market, it would be 5%, and then I'd add another 5% because I'm really trying to get out of the gate with 10% positions, and when the market is strong like it has been, can make all the difference.
And if we take a look at the weekly chart, one of the things I was certainly looking at, I had started this position, around the follow through day, and was, kind of looking at opportunities to increase the position size. We had that 3 weeks tight, and so that was kind of okay. That's an opportunity to increase a little bit. But now that we're undercutting that, I had to kind of get rid of those shares. And as you mentioned, we're right there at the 10-week moving average line now. It did kind of, we'll see if it gets support kind of at that 3 weeks tight low. It's right there. And I guess, so now you're just waiting for the bounce. What if it comes in a little bit further, below the 10-week moving average line? How much wiggle room do you give it? And if it happens early in the week, how much time do you give it to wait for that Friday, where a lot of times you might get some buying at the end of the week that pushes it back up above that 10-week moving average line?
Well, especially on the 10-week, given that the 50-day is well below it, it wouldn't be surprising for it to go through there and spend a few days below there. Sometimes the 10-week and the 50-day are much closer, but given how these stocks just kind of zoomed off the bottom, there's a lot of difference in the price between the daily and the weekly charts. So yeah, it won't bother me if it undercuts the 10-day, maybe even for this week, because
the 10-week, you mean?
The 10-week, yeah.
I'm sorry, yeah, the 10-week. But then I'll be looking at the 50-day and see how it handles itself around there. So it just comes down to the action once it hits these moving averages, and is there some support, and is some money coming back into the stock?
Yeah. Let's go ahead and switch gears. One of the standout areas has been the computer software security space. ZScaler. This is one that actually we have now on leaderboard as well, but ZScaler is one that's on leaderboard. What is it that you're looking at here?
Very similar situation. I mean, in late October, it was getting support at the 50-day, and then once we got the follow through, it just took off. Whereas before, it was kind of doing a stair-stepping way of moving higher, and then it just broke and kept going higher. So again, what's nice to see is that the volume of the past 2 days is generally lower than most of the up volume that it made. So I think from a volume point of view, it's looking good. That on both the days, there was some support. The stock did not close right at the low. And so again, maybe this will take a few more days, and that 50-day will get to around 200, and that would be a really logical place for support to come in at a round number. And again, I'll be watching that and setting alerts, and then looking at the intraday charts, and hopefully building a position.
Mm-hmm. And if we could switch to the weekly real quick,
Mhm.
something that is an issue with this one is there has been this overhead supply from back in 2021, and actually, that level right around 230 that it got to. If you kind of draw a line straight back from there, you can kind of see that this was an area of resistance where it had a cup that it formed in
Yeah.
2021. So, how much are you looking at this old potential resistance? I mean, now this is like 2 years, more than 2 years old. Is it still relevant or not?
That is not so much relevant, but that on the way down, I think all those peaks are areas that you're going to run into trouble, because there are people who bought there and they're still saying, okay, when it comes back, that's where I'm getting out. And so those are still in play.
Like 300, that was a
Yeah,
peak, and 340. So
exactly.
yeah, you've
All
got
those
a few of
peaks.
them. Okay. Definitely worth watching. Let's go ahead and shift over to Uber, another leaderboard stock that we've got a good gain on, and it looks very similar. We were encouraged by such tight action in a lot of these stocks. The 3 weeks tight that was happening for a lot of stocks, letting the moving averages catch up, and now we're just kind of undercutting a lot of that space. So talk to us a little bit about Uber and what you're looking for here.
Well, Uber, when we were putting together the paper on Friday, I think almost every stock on the first page of the IBD 50 had a 3 weeks tight. It was amazing that there had been that many 3 weeks tights. Yes, we saw them all over the market. They were trading very tightly along with the market. This one, had above average volume on that first day. It closed near the low. At least today, there wasn't, too much of a loss, and it came up off the bottom. So that's looking a little better. And again, I'd prefer it if it takes a few days to get down to the 50-day. If it tomorrow goes down to the 50-day, I'm probably not going to be as excited about this one. But so far, it's acting fairly well. I mean, yesterday's gap through there and then closing near the low did not look great. Today's action is much better, in my opinion.
Now switching over to the weekly chart, this is another one that's right at the 50-day or a couple of percent right above it. It actually looks like it touched it a little bit there.
The 10-week line, right?
Oh, sorry, the 10-week line. Are there ever any scenarios where you'll just say, you know what, I'm going to use a 10-week line because it's just such a gap before the 50-day, or are you generally just going to stay with the 50-day?
Well, usually, like I was saying before, there's a lot more difference between the 10-week and the 50-day in this environment, because things just took off so quickly. Usually they're a little closer. So again, I'm looking at the 10-week, but I'm probably looking much closer at the 50-day.
And also, I noticed that it looks like at the IBD Mutual Fund Index, Fidelity Contra Fund's actually reducing the position. Does that ever come into play when you're analyzing a pullback that you might be interested in?
Well, that is usually the quarter just ended, so that's fairly up to date, and it looks like they were probably selling into some strength. Again, looking at this stock and saying, this is probably unsustainable. But I guess I look more at this when I'm buying rather than when I'm holding. Maybe I should, but I take my cues mainly from the chart action.
One more thing on Uber, the
Mhm.
fundamentals on this are very different from ServiceNow and ZScaler. Both of those have 99 EPS ratings. This has an 81. It just turned from, some losses in terms of its EPS to now it's profitable. And, the next year is looking pretty strong as well in terms of the estimates for 2024. Does that go into your calculus when determining, okay, the level of conviction that you have, when you have something that's more speculative? Again, this has just turned profitable.
Right. So let's say I was looking at a stock like this, and I see that the sales growth has really decelerated. That would be a big problem if the estimate for next year wasn't. Let's say the estimate was like 10% or 12%, something like that. Then I'm like, this thing is probably running out of steam. The fact that the estimate is fairly strong for next year, then I would have more conviction about doing this. But I'd like to dig in a little deeper and see what the sales estimates might look like, and just have a better feel for what could be in the offing.
Yeah. And I should mention that, the 2024 estimate is for a 68% increase in EPS. And, sometimes I'll get a little bit nervous when that's off of like an EPS of a few pennies, where it's like,
Right.
okay, well, that's not as meaningful. But this is off of an EPS of $1.05, for the estimate for 2023. And you would assume that they're going to be pretty close to that, given that this is the last quarter coming out. So it's not like we're dealing with pennies here.
Yeah, it's whenever you have a much larger number, and you're right, when it's not pennies, then you can feel a little more confident about that percentage change.
Yeah, but of course, we'll have to see what happens with earnings season, which is right around the corner. So maybe before we go, you can just kind of address that. With the fourth quarter ending, a lot of the fiscal years ending for stocks, we're going to be looking at the earnings season coming up, and as stocks are pulling back, we could be getting some of those bounces, and
Mhm.
the recovery could be happening right in the throes of our next earnings season. So what's kind of the way to handle that if that scenario plays out?
Well, assuming that this is a real bull market, I'm more inclined to buy options around earnings in that early in a stock's run. It's not a good strategy when it's already up 400% or something like that. So that is one thing to do. The other is, again, if you're taking smaller positions and you're willing to risk a little bit around earnings, maybe you don't want to buy right ahead of earnings, but if you get in a few days early and you've got 3 or 4% gain, okay, well, you might lose all of that, but at least you're not going to get completely whacked, most likely. So I think that between buying options and also buying the earnings gaps when they, especially if they're gapping out of bases or consolidation areas, this is the time to do it. That's when that strategy works very well.
Yeah, and you can look at like Uber when it reported earnings back in May. It had that earnings gap, and that was kind of the catalyst for its first initial run in 2023.
And the same thing, it reported earnings right around the time that the market followed through.
That's true.
Yeah. Very good. Well, hey, Chris, always a pleasure having you on the show. We'll have to make sure it's not too long, but we'll put it on your calendar much earlier. I'm sure we'll still get the, wait a minute, when did I agree to this? But that's okay.
Sure.
Always great having you on.
Thank you. Really good to be with you guys.
Yeah, that's going to wrap it up for this episode. Thanks a lot for joining us for the new year. Hope all of you have a great 2024, and I hope you stick with us week in, week out. Definitely worth coming in next week because we're going to have Matt Caruso from Caruso Insights. He always has such great knowledge to share, a great educator. So we hope you join us for that. Thanks a lot for watching this week, and we'll see you next time. Bye now.